All right, let's get right to it. Think of this as your intensive pre-exam masterclass on the repo rate. We're not just scratching the surface here, we're going deep. We're going to follow the entire chain of events from a single transaction between banks all the way to how it affects the entire economy. Let's really get into the nitty-gritty.
So here's our game plan. We'll kick things off with the absolute basics of a single deal. Then we'll zoom out to see the RBI's playbook. After that, we trace the ripple effect through the whole system, look at how theory differs from reality, bust some common myths, and wrap it all up with the one causal chain you absolutely need to remember.
Okay, let's start at ground zero, the actual mechanics of a single repo transaction. You have to understand this part because, well, everything else is built on top of it. It's the fundamental building block.
You know, it's so important to think beyond the academic definitions. In the real world, this isn't some abstract concept. It's a treasurer at a commercial bank under pressure, needing to manage their daily cash flow. It's a real-world, high-speed transaction that keeps our entire financial system humming along. To really get the flow, you've got to know the players. It all starts at the top with the RBI, the central bank. Now, their first point of contact isn't you or me. It's the commercial banks. From there, the effects start to trickle down to businesses and individuals, and that's what ultimately shapes the economy as a whole. That sequence is key. So here's the play-by-play. Imagine a bank is short on cash, maybe just for overnight. They go to the RBI, but they can't just ask for money. They have to put something up as a pledge, in this case, government securities. The RBI takes the securities and gives the bank the cash. But here's the final crucial step. The bank makes a legally binding promise to buy back those exact same securities later, and they have to pay interest. And that interest, that's the repo rate.
Let's be absolutely crystal clear on this word, collateral. We're not talking about a house or gold here. The asset being pledged, the thing that makes the loan secure, is always high-quality, super liquid government securities, or GSECs. This is really the bedrock of the entire transaction.
Okay, quick pop quiz. Let's lock this in before we move on. What is that specific asset that the commercial bank gives to the RBI as their part of the deal? If you're thinking government securities, you are spot on. That's a detail you can't forget.
And this brings us to why it's called a repo in the first place. It's short for repurchase agreement. The name itself tells you the story. The bank is legally obligated to buy back the collateral. This isn't just a suggestion, it's a contract. And if they fail to do so, the consequences are serious. They lose the securities and face major penalties from the central bank.
Okay, so we've looked at a single transaction under a microscope. Now, let's zoom out. We're going to see how the RBI uses this one type of operation as a powerful tool to manage the amount of cash or liquidity in the entire financial system. So why do banks turn to the RBI in the first place? Well, because the RBI plays the critical role of the lender of last resort. Picture this. There's a sudden cash crunch across the system, and banks stop lending to each other, or the interest rates they charge each other skyrocket. When a bank can't get the short-term funds it needs from other banks, the RBI steps in. This isn't about bailing out one bank. It's about preventing one problem from turning into a system-wide crisis.
At the end of the day, the RBI has two main goals with these tools, either putting money into the system or taking it out. When cash is tight, they use repo operations to inject liquidity. But when there's too much cash floating around, which can fuel inflation, they use reverse repo operations to soak it up. It's really two sides of the same coin.
This slide lays it out perfectly. With a standard repo, the RBI is the lender, the commercial bank is the borrower, and the goal is to inject cash. With a reverse repo, the roles completely flip. The bank becomes the lender, the RBI is the borrower, and the goal is to absorb or pull out extra cash. The easiest way to keep it straight is just to ask, who's doing the borrowing?
Right, so we have the tool. Now let's trace its impact. This is what we call the monetary transmission chain. It's the journey of a single policy decision from the RBI's headquarters all the way down to your monthly loan payment.
Let's follow the dominoes when there's a rate hike. First, the RBI raises the repo rate. Right away, it becomes more expensive for commercial banks to borrow from the central bank. That increased cost then spreads to the rates banks charge each other. Now, to protect their own profits, what do the banks do? They pass that higher cost on to us, their customers. So home loans, car loans, business loans, they all get more expensive. What happens next? Naturally, people and businesses borrow less and spend less. This cools down the overall demand in the economy and helps bring inflation under control. So here's the crucial takeaway. Just think of the repo rate as the main brake and accelerator for the economy. When inflation is getting too high, the RBI steps on the brakes with higher rates. When the economy is sluggish and needs a jumpstart, they hit the accelerator with lower rates. Simple as that.
Okay, one more check to make sure this is sinking in. What's the name for that whole chain reaction we just talked about? The process that carries the repo rate's impact all the way down to you and me. That's the monetary transmission mechanism. You'll definitely want to remember that term.
Now for the really interesting part, the stuff that separates a good answer from a great one. In the textbooks, this whole transmission process looks smooth and perfect. But in the real world, oh, it's messy. Let's talk about the delays and the hiccups that happen in reality.
A huge mistake is to think these changes happen instantly. They absolutely don't. After the RBI announces a rate change, it can easily take 3 to 6 months before we see any real change in borrowing and spending habits. And it can take a year, sometimes even longer, for the full effect to work its way through the entire economy. That's why central bankers always have to be looking ahead, making decisions based on where they think the economy is going, not where it is today.
And this right here is the secret to understanding financial markets. They don't react to the news itself, they react to the surprise in the news. If everyone expects a quarter-point hike and that's what we get, the market barely blinks. It's already been priced in. But if they deliver a surprise half-point hike, you'll see immediate, sharp movements in stocks, bonds, and currencies. It's all about expectations.
And finally, never think this decision is made in a bubble. The Monetary Policy Committee is looking at a whole dashboard of indicators. Yes, inflation is the #1 target, but they're constantly balancing that against GDP growth, what's happening in the global economy, and the stability of our currency. They even have to keep an eye on the national fiscal deficit, because if the government is borrowing a lot, that can create its own inflationary pressures. It's a very complex juggling act.
Okay, listen up, because this is important. We're going to go over the 3 biggest mistakes people make when talking about this topic. If you can avoid these, you'll show you really know your stuff. Myth number 1, the RBI sets my home loan rate. Nope. The reality is the RBI sets the rate at which banks borrow from it, and that influences your rate. Myth 2, the effects are immediate. Wrong. As we just saw, there's a big time lag. And myth 3, it's only about inflation. Not true. It's a careful balance between fighting inflation, promoting growth, and ensuring stability. Get those nuances right and you're golden.
Okay, let's bring this all home. We're going to wrap everything up into one final, clean takeaway. If you remember just one thing from our discussion today, make it this causal chain.
And that really is the bottom line. The repo rate is so much more than just a number you hear on the news. It's the first domino in a powerful chain reaction that determines the cost of money for everyone, from the biggest corporations to you and me. Understand that chain, and you really understand the heart of modern monetary policy.